Hello, friends. The biggest tax bill in over 40 years was signed into law, and buried inside it are 3 changes that directly affect your money. Now, most of the news coverage talked about politics, but almost nobody sat down and explained what this bill actually does for people over 65. There is real money sitting inside this law, and I am not talking about small change. I am talking about thousands of dollars in new deductions. But here is the part that really got my attention. The same bill that gives you money in one hand quietly takes something away with the other. So today I am breaking down all 3 changes in plain English with exact dollar amounts, exact forms, and exact steps you can take right now. And honestly, if you are someone who watches these videos to stay ahead of the rules before deadlines pass, just go ahead and hit subscribe real quick. I put these out because the government changes things every single year, and they expect you to already know, which is honestly not fair to anyone. All right, so let us get right into change number 1, because this is the one that puts the most cash back into your pocket starting this tax year. The One Big Beautiful Bill created a brand new deduction worth $6,000 per person for anyone who is 65 or older by year end. And if you are married and both of you are 65 or older, that number doubles to $12,000, which is not a small amount at all. Now here is what makes this interesting. This is not replacing anything you already get. This is stacked right on top of your existing standard deduction. So if you are single and 65, your regular standard deduction is $15,750, plus the existing $2,000 senior add-on. You add the new $6,000 on top of that, and your total deduction for the year comes out to $23,750. For a married couple where both spouses are 65 or older, the total stacked deduction can go as high as $46,700. Now, I know some of you are thinking, okay, but how much does that actually save me in real money? Not deduction money, but actual cash in my pocket. Fair question. If you are in the 12% tax bracket, $6,000 in deductions saves you about $720 in taxes. And if you happen to be in the 22% bracket, that same $6,000 deduction puts about $1,320 back. Now here is the part nobody is talking about, and I really wish more people would pay attention to this because it is a trap hiding in plain sight. If your modified adjusted gross income is over $75,000 for single filers or over $150,000 for married couples, the deduction starts shrinking. It goes down by 6% for every dollar you earn above that threshold. And once you hit $175,000 single or $250,000 joint, it is gone completely. So the people who need to pay close attention are those earning somewhere between $75,000 and $175,000, because your number is somewhere in between. To claim this deduction, you file a brand new form called Schedule 1A. It is a 1-page form you attach to your regular 1040 or 1040 SR. And here is something a lot of people do not realize. You do not have to itemize your taxes to get this. It works whether you itemize or take the standard. One more thing before we move on. This deduction is temporary. It covers tax years 2025 through 2028, and then it expires. So you have a 4-year window right now, and honestly, if you do not take advantage of it during that time, it may never come back again. Nobody knows. All right, change number 2 is a big deal for anyone who owns a home and pays property taxes, and this one kind of flew under the radar for most people. Before this bill, you could only deduct $10,000 of your state and local taxes combined. That is what they call the SALT cap on your taxes. That $10,000 cap has been squeezing homeowners for years, especially in states where property taxes alone can eat up that entire amount by themselves. Well, the new law just quadrupled that cap from $10,000 to $40,000, which means you can now deduct up to 4 times more than before. Now think about what that means if you are a senior homeowner paying $8,000 or $10,000 a year in property taxes, plus state income tax on top of that. Under the old rules, you lost the deduction on everything above $10,000. But now you have room to breathe because the cap went up to $40,000. This does affect whether you should itemize or take the standard deduction, though, so it is worth sitting down and running the numbers for your specific situation. The cap increases by 1% each year through 2029. So in 2026, it is actually $40,400, just so you know. But fair warning, in 2030, this cap drops all the way back down to $10,000. So this is also a limited window, just like the senior deduction. Now, change number 3 is one that I feel very strongly about because it affects a group of seniors that almost nobody in the media ever talks about. If you are a grandparent raising your grandchild, or an aunt or uncle acting as a caregiver, this part of the bill was basically written with you in mind. The child tax credit went up from $2,000 to $2,200 per qualifying child under 17, and caregivers can absolutely claim this credit. So if you are raising 2 grandchildren, that is $4,400 in tax credits. And remember, a credit is not a deduction. It reduces your tax bill directly. The child needs a Social Security number. You claim it on your regular 1040, and the phase-out does not start until $200,000 for single filers. A lot of grandparents I hear from had no idea they could claim this credit. They just assumed it was only for parents, but that is not how the law works. Now, I have to be honest with you about something, because I would not feel right if I only told you the good parts and left out the warning that comes with it. Buried inside this exact same bill is a provision that could strip health care from over 5 million Americans, and a huge number of them are older adults. Starting January 1st, 2027, if you are between 19 and 64 and you are on Medicaid, you must prove 80 hours a month of work activity. If you cannot prove those 80 hours through work or volunteering or school, you lose your Medicaid coverage, and there is no automatic backup plan waiting for you. The Congressional Budget Office estimated that 5.2 million adults will lose their Medicaid coverage because of this one single provision in the bill. Now, there are exemptions. If you are pregnant, if you have a disability, if you are a caretaker of a young child, you may qualify for an exemption from this. But here is the problem. Most of those exemptions are not automatic. You have to prove your status, and the paperwork system is not built to make that easy. If you are between 50 and 64 and currently on Medicaid, please contact your state Medicaid office now and verify your exemption status before the deadline. Because losing Medicaid at that age means the average marketplace plan would cost you over $12,600 a year with no subsidy at all. So let me bring it all together for you, because I know that was a lot of information, and I want to make sure you walk away knowing exactly what to do. Change number 1. There is a brand new $6,000 deduction for everyone 65 and older, and you claim it by filing Schedule 1A with your taxes. Change number 2. The SALT cap jumped from $10,000 to $40,000, which is huge for senior homeowners paying high property taxes in expensive states. Change number 3. If you are a grandparent raising a grandchild, you can now claim $2,200 per child in tax credits directly on your return. And the warning, if you are on Medicaid and you are between 50 and 64, do not wait until 2027. Start verifying your exemption status today. The IRS number is 1-800-829-1040, and Social Security can be reached at 1-800-772-1040. 1213. You can also go to benefitscheckup.org, which is a free tool from the National Council on Aging that checks every single program you might qualify for. I know this is a lot to process, but this is exactly why I make these videos, because nobody else is going to sit you down and walk you through all of it. If this helped you understand something you did not know before, share it with someone in your life who is over 65. It could genuinely change their year. And if you want to stay ahead of every rule change that affects your money, your benefits, and your rights, subscribe and turn on that bell so you never miss one. Thank you for being here, friends. I will see you in the next one. And until then, remember, the money is there, but nobody is going to hand it to you.